In this section, we're going to continue discussing about the unit second of financial management, and specifically around the concept of returns on fixed income securities and how do we arrive at the value of a fixed income security. We're going to borrow heavily from what we have already learned in the net present value concepts and finding the present value of a particular set of cash flows. And that concept is going to get implemented in details around this entire understanding of valuation of fixed income securities, right? To understand this valuation of fixed income securities, let us first arrive at a basic understanding. What is the concept of a return on a fixed income security, right? So when we talk about returns, it is important for us to understand how much returns can be made on a fixed income security and how do we actually calculate that. Once we zero down on this, then it becomes easier for us to actually replicate this and use this in the pricing of a fixed income security as we go along, right? So let's understand the beginning of return or yield. Yield is essentially nothing but what we're going to call as the returns that someone can make on a bond. Let's understand the concept of yield on a bond, right? Assume that an issuer comes to issue a bond with a tenure 1 year and an interest rate of 8%. This means that for every rupees 100 raised, the payout at the end of the year would be 108, right? So you've invested rupees 100 in year 0, and at the end of year 1 you're going to get 108. So what is the return on this instrument? Can we find the return? The return is essentially 108 minus 100. That's 8 rupees that you made on an initial investment of 100. That's going to be equal to 8%, right? So that's the yield on this instrument as it stands now. Now suppose the price at which the bond is bought by the first investor is different. It's not 100. It is either higher than 100 or lesser than 100. How does the return change in that case, right? So let's try and use an Excel file and try and understand this there. So this is the example we are looking at. And what we are saying is that the return, if we calculate here based on the formula, was 108 minus 100 divided by 100. That's the return, correct? And in other words, we could kind of say that this is 8 by 100 is the return that we're looking at, right? Let's calculate the return here. If this was bought at the correct price, that's 108 minus 100 divided by 100, and let's convert it to percentages. That's 8%, right? Now let's assume for a minute that this company came to issue this bond at 100 and 100 rupees with an 8% interest rate, but the market did not buy it. So they came and did the auction at 100, but no one bid at 100. Now what will happen in the market? In a general market, if you're trying to sell something for 100 and no one is willing to buy it, you will reduce the price. So you reduce price to 99, and let's say it gets sold at 99. Now what is the return? Can we find out the return? Essentially, you're paying 99 here instead of 100. What happens to the return? That becomes 9.1%. Why? Is because now the return calculation will be 108 minus 99 on 99. On your initial investment of 99 rupees, you have made 9 rupees. Why? Is because 108 is fixed. Why is it fixed? Is because the face value is rupees 100 and the coupon is 8%, and both of these are fixed. That's why it is called a fixed income security, right? Because your end outflow is fixed. If you pay lesser, if you pay 99, then you're going to make a bigger return because you're going to make 108 on 99 now. If you paid 98, the return would be even higher, right? So if you paid 98, the return would be 10.2%. So the lesser you pay for the bond, the bigger the return keeps becoming. On the contrary, let's say you came and bid at 100 rupees and someone came and bid, you came and opened the auction at 100 rupees and someone came and bid at 101. They were willing to buy it at 101, which means the return was 6.9%. Now, someone will only buy it at 101 if they are happy with a return of 6.9%. So essentially, the price is defining the return. And one thing that is very clear is that the yield or the return that you are making on this yield or return that you are making on this is inversely proportional to the price that someone is paying. Higher the price, high price will mean low yield, and low price will mean high yield. Correct? So that's the first understanding that we get. We are trying to essentially understand what is the return on a particular bond or a yield on a particular bond, also commonly known as the same premise of yield is also known as YTM. What does YTM mean? That's yield to maturity. Remember, this return of 6.9% is only going to come if you hold it to the maturity of the bond. That's when 108 comes to you. If you sell in between, the price could be different. We don't know what that price is, right? So that's an important premise. Two or three points that we have understood here is one, the higher you pay initially, the lower your return would be. The lower you pay, the higher your return would be. Two, your return is only fixed at this number if you hold it to the final cash flow date. If you sell it in between, the price you sell could be completely different. You might sell it at 106, you might sell it at 105, right? So effectively, that's the return is defined as yield to maturity because you're going to hold it to the end of the period. So, right? So when we say yield, it's also commonly referred to as YTM. And I'll again write it. YTM is nothing but yield to maturity. In simple words, what is the return that you're going to make on the bond if you hold it to maturity, right? Let's take another example. Assume a bond gives 121 after 2 years and nothing in between. What is the return? So now you're saying in year 0, you pay 100. In year 1, there is nothing. In year 2, there is 121 payment, right? Now, theoretically speaking, you would realize this number is going to be about 10%, is because if you invest 100 rupees today at 10%, then after 2 years, you'll get 121. That's compounding for us, right? But let's mathematically try and calculate how do we arrive at this number, right? How do we get to this number in terms of our discussion? For that, let's go to the sheet 2, which is bond yields 2, and we have this premise given here. In year 1, there is no payment that is happening, right? So year 0 is minus 100, 1, 2. Right now, the concept of this could be explained because these are equidistant regular cash flows. Remember, we could have used the same premise here as well. If I had, let's just insert a row here. If I had put in the first outflow as minus 99 and the second one as 108, could I have calculated the return using some function, right? Remember, we had used this function called IRR. So IRR is nothing but if we put in these two values, it should give us the same value, right? That's what IRR is. You will see IRR gives you the same value. So I can put in IRR here and that gives me the return value, which means that the same should be applicable here as well. Can I use IRR as a function and calculate the data? Now it's important for us to give 0 in between is because otherwise Excel will not understand whether, so if I don't give this 0 and I just put in the set of cash flows as minus 100 and 121, Excel will believe that 121 is coming in the first year, right? And if I do an IRR of this, remember IRR needs one negative signal, it'll give a 21% return. That's not true because this 121 is coming in the second year. So we will need to put in a 0 in between. Let's try and calculate IRR. And we calculate IRR and we realize the number is going to be 10%, right? And that return basically gives us what is the return on this bond, because if you were to put in 100 rupees initially, if you were to put in 100 rupees and that's going to get invested for 2 years at a certain rate and going to give you 121, this R is calculated as 10%, right? And how did we arrive at this? That's a straight calculation of 121 divided by 100 raised to the power half minus 1. I can solve this equation and this equation will give me 10%, correct? So that's what we did, and we arrived at a return of 10%. Now, if you were to pay more, let's say you paid 102. If you paid 102, your return would have been 8.9%. If you paid 98 on the other hand, would the return increase or decrease? Lower the price, higher the return, higher than the initial value explained, right? So that's what we get here. Now we could change this a little bit, and remember our discussion that we could let's change this entire set of bonds and say that instead of a bond that gives 121 at the end of the second year, can we have a bond that takes 100, gives 10 in year 1 and gives 110 in year 2, right? So what I'm going to do is I'm going to copy this and paste it here, right? And then I'm going to change the yardsticks of the second bond to this. So the second bond is an annual pay bond which gives 10% every year, and we realize that it's a 2-year bond which pays, so it's a 2-year bond with coupon of 10%, correct? That's how the payment would be, right? Face value is 100 and issue price is also 100 in this case. And based on these numbers, we arrive at a return or yield of 10%, which means both these bonds are technically the same because they're giving the same return. You put in 100 rupees and they give you whatever set of cash flows they give you the same return at the end of it. Now, the fact that these two are the same is going to have more implications for us in future. But at this point of time, what is more important is for us to understand what happens if we buy the bond slightly higher than 100 rupees. So at 101, you see the return goes down. And if you buy it slightly lower, your return increases because you're paying lesser and you're getting more, right? But this concept of IRR now will bring us back to the concept of saying that in a sense, what we are trying to do is find the present value. In the first example, we calculated the return using this function called 100 into 1 plus r square is 121, which means 100 is going to be 121 divided by 1 plus r square, right? And you solve for r in this equation. In the second one, the first cash flow is 10. The present value of this will be 10 by 1 plus r. The second cash flow is 110 and the present value of this will be 1 plus r square. And when you solve for this equation to find the net present value of the entire thing, that needs to be equal to 100. If this is 100, r will solve itself to 10%. That's what the IRR equation does, right? So now we are getting closer to generalizing the formula of valuation of a bond, right? Let's go back to our slides and it will become clearer as we go along there to understand what we are working towards. That's the bond we discussed and that's the data we looked at. Let's first generalize a few points. If the bond is issued at par, when we say something is issued at par, par is the same as face value, which means it is issued at 100 or 10 or 10,000, depending on what the face value is, and it is trading at par, the return would be the same as the coupon rate. Remember, 100, 108, coupon is 8%, yield is 8%, right? If the bond is issued at premium, which means above rupees 100 or face value, let's say 101, and the final value is 108, your return was approximately 7%. Return is less than the coupon rate of 8%, right? So if the bond is issued at a premium, then the return would be lower than the coupon rate, right? If the bond is issued at below rupees 100 or the face value, so if the bond is issued at 99 and the final value is this, the return, which is equal to about 9%, is going to be greater than the coupon, which is at 8%, right? This is a bond issued at premium. This is called a bond issued at premium. This is a bond that is issued at a discount, right? Discount bonds will give higher returns, premium bonds will give lower returns. That's a straightforward mathematical equation. We just saw that in the example that we saw, that if you're buying the bond at more than 100 rupees, then your return is going to go down. If you are buying the bond at less than 100 rupees, your return is going to go up. That's the first concept we learned, right? Bond prices and the return you make are inversely proportional. They are opposite to each other. So if prices go up, returns go down. Correct? Now, how do we arrive at the bond price? So simply put, the market demand supply dynamics decide. If there are too many buyers at 100, then the bond will sell at 100. If there is no buyer at 100, then the bond price will go down. If the bond price goes down, the return goes up. So essentially, demand supply, simple demand and supply will determine what is going to be the price, which will determine what is going to be the yield on any particular bond. Simple concept of demand and supply, right? In other words, think about it this way. Why is there lesser demand? Let's say a bond comes at 100 and says we're going to pay 108 at the end of year one, right? And the demand is lesser demand at 100. We need to question, why is it so? Why is the demand low? Why are people not buying it at 100? Is possibly because investors want a return that is greater than 8%. That's why no one is buying it at 100. If they were okay with 8%, they would have bought it at 100. If they were okay with less than 8%, they would have given more than 100, right? The fact that they are not buying it at 100 means that they want a return of more than 8%. In other words, if your expected return is greater than the coupon rate, then you will not buy the bond at par. You will pay lesser than the par value. If your expected return is greater than 8%, buy at less price. That's a simple concept, right? Because the lower you pay, the bigger your return is. So essentially what you're trying to do is find the present value of cash flows that a bond is going to give you at a discount rate, remember, which is nothing but your expected return. How is this different from the NPV equation we saw? All we are trying to do is find the NPV at my required rate of return, right? That's where the concept of present value gets embedded into the valuation of a bond price. All we have to do is we have to take three steps. First, we have to find the expected cash flows. There are two types of cash flows in a bond. There's a coupon payment and there's a principal payment. Both are fixed, right? So far, we have not looked at concepts or structures of bonds where these payments could be floating. So far, both these payments are essentially fixed. When they are fixed, the cash flows are kind of defined. Once we say there is a bond with a coupon of 8%, maturity of 5 years, and face value of 100, the cash flows are fairly fixed. 1, 2, 3, 4, 5. We know it's going to give 8, 8, 8, 8, 8, and 100 in the fifth year. That's the set of cash flows. These are fixed. Now you have to determine appropriate discount rate, right? We are trying to find the present value of all these. So you have to find out what this R is. 1 plus R cube, 1 plus R 4, and 1 plus R to the power 5. What is your expected return? If your expected return is 8%, which is what the coupon rate is, then the bond value will work out to exactly 100 rupees. All you're doing is discounting this set of cash flows. The sum of all these present values is what you are looking at as the final value of the bond. That's all you are doing. That's the equation that we saw. If a bond has a maturity of n years, it's paying coupon at a certain rate, coupon 1, coupon 2, coupon 3, the discount rate R being your expected value or return from the bond, and you just find the present value of all the cash flows, right? So in our example, we could have said the bond is a combination of 5 bonds, one which pays 8 rupees at the end of first year, second which pays 8 rupees at the end of second year, third which pays 8 rupees at the end of third year, fourth which pays 8 rupees at the end of fourth year, and finally the fifth one which pays 108 at the end of the fifth year, right? 108 at the end of the fifth year. These are 5 different bonds, and because these are 5 different payoffs or payments, I shouldn't say bonds. This bond can be considered as a combination of these 5 cash flows. The present value of all these 5 is what is going to give me the value of the bond, right? That's what we are trying to find out. There are some properties of the present value. Higher the discount rate, which is essentially, we'll look at the second one first, lower the present value or lower the bond's value. Logical, because if I want a bigger return, I'll pay the lesser price, right? So if coupon rate is 8% and the required rate is 8%, then the price would work out to par. But if this goes up to 9, this goes up to 10, then logically the price will keep falling because I am dividing it by a bigger number, right? All the cash flows are getting divided by a bigger number. And logically, if I want a bigger return and the payout is fixed, then I have to pay lesser, right? And for any given discount rate, the present value decreases as we go further into the future. That's logical, right? Because your first cash flow is getting divided only by 1 plus r, but the second cash flow is getting divided by 1 plus r square. So for any given rate, as you keep going into the future, the present value will keep going lower and lower and lower, right? That's logical. We will look at this example as we go and try and solve. Let's assume there is a 5-year annual pay bond with a coupon rate of 8%. So as you look at this bond, it's a 5-year annual pay bond, coupon of 8%. So the payments are fixed at 8, 8, 8, 8, and 108. If my expected rate of return is 9%, each of the cash flows will have to be found. So this is present value 1, this is present value 2, this is present value 3, present value 4, present value 5. In a sense, I'm trying to just find the net present value of all these, right? And at a discount rate of 9%, we will note that PV1 will be greater than PV2, which will be greater than PV3. That's the first condition we saw, is for the same cash flow and for the same discount rate, as you move into the future, right, the present value will keep becoming lower. That's because you're dividing by the power of 1 here, the power of 2 here, and the power of 3 here. So obviously the number will keep becoming smaller and smaller, right? Let's try and solve this on our Excel file. So this is the bond we are looking at, right? How do I actually find it? So let's assume my expected return is what we said is 9%, right? And we're paying minus 100. So there are two ways to solve this. Either we basically find what is the NPV or net present value at 9% of, remember, NPV assumes that your first cash flow happens at the end of the first year, and you calculate this. If you want 9%, then you're going to pay 96.11. I don't need this minus 100 here because that's what we are trying to find. You need to pay 96.11 if you want a 9% return on this. The other way we can do it is if we can calculate and try and find out the net present value of each of these, which is this divided by 1 plus 9% and this divided by 1 plus 9% square and so on and so forth, right? So let's do that part of the equation as well and try and find present values of all these cash flows. So these are the cash flows. Let's find present value of cash flows, right? Let's do that. So effectively 8%, 8 divided by 1 plus 9%, because I'm going to drag it to the right, I'm going to freeze this 9% and raise to the power the timing of the cash flow, 1 year, right? So we find 7.33 is the number, 7.34 to be precise. As I drag it on the right side, I'll find 6.73. So for the same discount rate, the cash flows, the present value keeps becoming lower and lower as we go further into the future. Select all this and find the sum of present values. Let's see what is the sum of all these present values. And we get the same value, 96.11. If we sum these present values, that's the same as what we calculated using the net present value. That's how we value a bond. All we need to do now is try and check if we want to, if let's say my expected rate of return is 10%, should I pay more for the bond or should I pay less? Remember, the payouts are fixed. So higher my expected return, lower the price that I should pay. If I have an expected return of 8%, the price will work out to exactly 100 rupees. If I have an expected return of 7%, I can pay 104 and still make the same amount of money, right? So once I have defined what is my expected return, automatically my price will get calculated as the sum of the present values of all these cash flows. That's where the concept of discounting becomes important. Let's format all these. That's what we were trying to do. The cash flows were fixed. We defined what the cash flows were. We defined what our expected rate of return was. And once we define that and we find the present values, we can find the present values here, add up all the present values that give us this value. Mathematically, the NPV function also gives us the same value at the same return. And so logically, bond valuation is nothing but an extension of the concept of present values calculation that we had seen, right? That's all we are doing. That's all that is there to bond valuation that we saw, is every coupon has to be discounted at my expected rate of return. That's how I calculate the price. I can also back calculate it and say if a price is available in the market, then how do I determine the interest? The back calculation of that would be using the function IRR. So I will take all these set of cash flows and let's do a control C and control V, and let's assume I paid minus 98 for the bond, right? What is going to be my return slash yield? Here I can use the function IRR and I can select all this and I can calculate that my return is going to be 8.51%. If I paid minus 96.11, my return is going to be 9%. If I pay 99, return is lesser. If I pay 102, return is even lesser. It's 7.5%, right? So that's how you define the price and yield relationship. Nothing but an extension of the present value calculations that we have learned in the previous sections. That's how to value fixed income securities.